Your wealth deserves stability, expertise, security. Your wealth deserves LGT Crestone, private wealth with over a century of global heritage.
Hello and welcome to the Global View on this Wednesday. Well, let's start a look at the macro picture globally. Orders for US factory goods falling by 2.1% in July, nearly reversing the prior month's rise and ending a 4-month streak of gains. US Treasury yields have risen, and Fed Governor Christopher Wallace saying the resilience of the US economy suggests that the central bank need not change rates anytime soon, saying there's nothing that is saying we need to do anything imminent anytime soon, so we can just sit there, wait for the data, see if things continue. Well, the yield on the US 10-year Treasury note rose 9 basis points to 4.26%, and the 2-year was up 10 basis points to just shy of 5%. Elsewhere, global business activity largely slowed further last month as services firms struggled in the face of weak demand as rising prices and borrowing costs continue. China's services activity expanded at the slowest pace in 8 months in August as weak demand sees the world's second largest economy stutter. Meanwhile, Eurozone business activity declined faster than initially thought last month as the services industry fell into contraction. Germany's services sector contracted for the first time this year, and France's shrank more than first estimated, while the UK has suffered the sharpest business slowdown in 7 months. And concerns about global growth has seen the US dollar rise to close to a 6-month high against most major currencies, with investors opting for the safe haven US currency. The Aussie dollar slumping below 64 US cents after the Reserve Bank yesterday kept rates on hold at 4.1%. The Aussie trading at 63.7 US cents. Well, just taking a look at the Global Business Activity Survey, let's bring up a chart and we can just see where we've been over the past 12 months with the bluer, cooler colours indicating contraction there. And you can see August there, that trend re-emerging, particularly in some of those well-developed countries. Well, Germany, France, I've just mentioned what's going on, particularly more broadly there in the Eurozone, and Australia, of course, too, over the last couple of months in contraction, as is the UK. Well, the US equity market testing is expected to continue for the next 2 weeks ahead of the Fed's September meeting. That is the view of Howard Silverblatt from S&P Global, who I caught up with earlier.
The next 2 weeks, we expect volatility to continue to increase. Some reallocations in there. Earnings are over. We're looking towards, as you said, the Fed, but also the government is doing their budgets. So we expect issues to react on an individual basis as analysts start to update their projections, not just for Q4, but all of 2024. So again, there's going to be a lot behind the doors that we're going to be seeing now as compared to up front that we were seeing during earnings season as well as reporting season.
So the market essentially pricing in no move this month, but a good chance, perhaps, or is expectations that there may well be another quarter point hike sometime this year.
Yeah, the feeling is definitely that they're not doing anything now. You would see a strong reaction. You would need very good verbiage in order to support an increase this month. However, looking through to the November meeting, November 1, the expectations by that 40-45% of the market is that it will increase. And the market seems to be okay with that. They built in a potential increase for another 0.25%, as long as that's basically the last one that's coming out of the Fed, one for the vote, as it said here. So the verbiage from the chairman at the meeting is going to be important on the forward guidance. But the feeling is that if it's not done now, it's done in another quarter point. Strangely enough, though, the first cut, the estimate of when it was expected, obviously, has moved from Q1 to Q2. And now there's talk about Q3, that it may stay up higher for longer, whether we get the quarter of a point or not. And we're not going to see the first half cut. There's still a lot of people that think it's going to be in the first half. but it'll be data dependent. But the market's willing to accept a quarter of a point, and that the first quarter will not see an increase at this point.
Howard, do we see investors take into account seasonality at this point? Because, of course, history will tell you that September is the worst performing month.
It is 44% of the time it goes up. August has a much better record, but it didn't do that much better. The stats are nice, and you put them in order for certain reasons. That business usually comes back in September, and we start getting down to things. And you always find things over the summer that have to be redone and done over. But looking at this one now, it looks like the difficulties are going to be coming from Washington, why we may have some strains on the market. And that's because they'll be doing the budget again. They do it every year. And this year, it looks like we may get another government close down. So that gets the market nervous. The rule of thumb is that for every week the government's closed, you lose about 0.2% on GDP for that quarter. So that could really hurt at a time when we're hoping that the economy will be sustained by consumer spending, which is showing some strains, and government spending, which has projects.
Is it your anticipation, I guess, as we look towards the next presidential election, that politics will increasingly begin to move markets?
Yes, it's 16 months away and we haven't seen it, but every house, every portfolio manager has a list of stocks depending upon what outcome you come. The president has a lot of power to spend a lot of money. We're seeing that the student loan situation here. We'll expect to see more later on the year. So does Congress, both the House and the Senate, independent. So depending upon who is seen and perceived as winning, what combination, you're going to look to those stocks because those are the stocks that are going to be getting money. If you're putting money into social programs or defense or education, those are the companies that portfolio managers are going to run to go to get coverage for. But it's still a bit too early to see that. I would expect to see it after the primary. So we're talking the end of the first quarter, beginning of the second quarter of next year.
All right. Well, more immediately, I guess, what are you seeing with the VIX at the moment? And where are you seeing volatility head at this point?
Fear.
Yeah, right.
We're not seeing as much fear. I mean, the VIX is a formula, and it's based on the next 30 days. So you've got to see what's happening over those days. Obviously, as we get close to a potential government shutdown, you could see an increase on that. The volatility that we're seeing, though, is in the intradays. Stocks that are going up and down within the same day and changing directions to some degree. You get some buying and then you get selling, or you can't hold the level where you're at, and it gets tested right away. One of the items in there is, if you just look at the index as a simplistic one, the high and low over the day. Last month, being July, it was about 0.68% per day. And then last month it's over 1%, and this month looks like it's going to go up from there. So the intraday, even if they're not swings, the volatility where we're not seeing through, you're seeing selling with no buying, and then some of the sellers come in. You're not getting the same commitment. You're getting short bursts of up and down, and that volatility is difficult for portfolio managers to deal with.
Howard, what are you seeing with share market listings at the moment? Certainly, locally here in Australia, they pretty much dried up. We are seeing some movement there. Is there any movement in terms of IPOs stateside?
Yes, September is usually when they start coming back. Well, this is very small. You saw the Vietnamese electric car, which at one point there was a SPAC at $10. Went last month, started at $22 for the IPO. Went up to $93. In between, it went down to 11. That was mostly because of a float situation. But ARM, which is a semiconductor coming from SoftBank, that's on the road right now. They should price next week, and that's going to be very interesting. They're talking about $53 billion. So the appetite may be there. Testing the waters. It's difficult to tell because the IPO market has been so slow that anything coming out that gets the investors' attention is going to be followed. The question is there a big enough appetite that we could start increasing and getting a lot of them down? There's a lot on the shelf, a lot of places looking, and if the market could give some positive items to the IPO and they could be oversold, not just in technology, but other areas, that would be a positive for the IPO market. But up to this date now, it has not been good for underwriters.
Yeah, indeed. Just stock specifically, incidentally, Howard, I noticed that both Airbnb and Blackstone have now joined, will join the S&P 500 index.
And next week, they will. At the beginning of Monday, they open up. Blackstone, a lot of people have been talking about. Airbnb was the more interesting one, shall we say, especially on the street. Uh, it was taken up, and there's some difficulties in certain locations, especially in New York City here, where Airbnb now has to register. It's almost going to be closed out in New York. A lot of traders took it as a vote of confidence in the ability of the company to move forward. But neither of those issues were in the S&P mid cap or small cap. There's a normal progression of companies in the mid cap to move up to the 500, and those in the 500 who haven't done that well kind of to move down to the mid and the small cap. But these were two from outside the market, and because of that, they get a bigger hit in their price when they first start going up. Basically, institutions don't already own it, so they have to go to get it. About 18% of the S&P 500 is directly owned by licensed institutions. So 18% of those two stocks had to be picked up by institutions to follow the S&P 500, which is a large impact. And we saw that in the pricing today.
Howard Silverblatt from S&P 500. Oh, now let's take a look at, just before we go, the local market. We're expecting to open lower, as you can see, SPY futures there off 0.25%. Stay with us, the open just around the corner.